Hey, good morning, everybody. It's Hammer. Today is Wednesday, February 11th, 2026. I, of course, am the founder of Originator Success, Grab and Go Social, and Rate Sensei, 3 products as part of Hammer Solutions that help you to build your business in 2026. Be sure to check them out. Remember that I go live each and every weekday morning, 9:30 a.m. Eastern Time. Tomorrow may be a bit rushed. Going to be in the airport, heading on my way to my annual snowmobile trip with the boys. But I will be on tomorrow. But anyway, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time. If you're here this morning, say good morning. If you're watching on the replay, do me a favor and give me a hashtag replay in the comments. Let me know that you were here. You know what's funny? I did not have this problem a minute ago, and now I have it again, where the chat window disappeared. I'll have to refresh this. But anyway, I can see y'all. So good morning, y'all. Great to have you here. Good to see you, Megan Bissell and company. So remember, if you would like a reminder text that I'm going live, you can go ahead and sign up and get a reminder so you're not late to the show. hmmr.io/reminder, or use this cool QR code over here. Each day, we also send out a email. You can get that at ratelockadvice.com. Be sure to sign up for the daily email so you can get that data. And also, we have our text alert service to help you protect your pipeline. Learn more about that at ratetextalerts.com. So anyway, with all that said this morning, let's go ahead and pop into it. Good morning, Mr. Zane. Good to have you here, sir. Appreciate you being part of the call. So, all right, let's go in and let's talk about what's going on this morning and what it all means. So here we go. All right. So taking a look this morning, first thing to start with is the fact that mortgage-backed securities are down about 4 basis points on the day, as actually applies to pricing. Now, I put up a post on Facebook this morning showing the different things that were going on with the coupons. You can see here, this is Rate Alert. They were minus 55 basis points. And I said, well, who's right and who's wrong? And a lot of people pointed out this was the 5.5 coupon, whereas MBS Live was minus 4 basis points at the 5.0 coupon, and MBS Highway was minus 18 basis points. That was also the 5.0 coupon. So first things first, let me remind everybody, just as a learning experience, it really doesn't matter which coupon you're following that closely. You're not going to find a discrepancy of 50 basis points on the coupons. In fact, right now, if we take a look at MBS Live, using them as a reference point, because we can pull up the different coupon pricing pretty easy. Let me just adjust the screen over here and we'll put this. All right. So taking a look, the 5.0 currently down 3 basis points. The 5.5 shows up 4 basis points. The 6.0 up 3 basis points. The higher coupons doing a little bit better right now. So, but you're not going to see a huge difference. But if you take a look at Rate Alert, they were minus 55 and now they're minus 3. Big difference. What that shows you is that there was bad data in their trading. And what I love is when they actually remove evidence of it altogether. Take a look at here at their chart, and you will see that they've wiped that out altogether. They don't have that giant drop that was there to the minus. When we looked at minus 55 here, it was 100.94 at their 5.5 coupon. 100.94 is right about here. Notice that they eliminated all, signs of that. So just be careful. The point here isn't to discredit companies or piss all over anybody. It's just, I see LOs that live and die by this stuff, and you got to be careful. It's not It's not the end all do all. The difference, by the way, between MBS Highway and MBS Live is the fact that MBS Highway does not appear to net out the bond rollover. So yesterday was a bond rollover. What happens is when you're selling your mortgages into a coupon, that coupon closes and then you're selling to the next one. So it's usually months ahead. So like right now when you're closing loans, you're going to deliver them in February or March. The February coupon's closed. Now we're going to be March, April, right? So there's usually a small discrepancy in the coupons and in the rollover. The rollover isn't reflected in your pricing. So for all intents and purposes, we're down about 4 basis points on the day from yesterday because the jobs data came out wicked strong, much stronger than expected. And we'll go into a little more detail on that. But basically, again, I just trying to show you why, because I'm going to get questions and someone's going to be like, oh, Hammer, you were wrong. You know, this other service said this. Doesn't mean that I was wrong. What it means is you have to understand what the services are saying. And when we look at this, MBS Highway is not right or wrong. MBS Live is not right or wrong. It's how they're choosing to show the information to make it best usable by their users. MBS Live is choosing to remove that bond rollover, even though it is calculated and shown in the raw number, because yesterday mortgage-backed securities ended the day at 100.7, but the bond rollover was about 10 basis points. So put that at 99.97, and now we're at 99.93. And there's your 4 basis points, right? So if it was 99. So hopefully this helps somebody when they understand this one today. Leslie said she had one borrower that wanted to float into today, and it's not going to hurt them that bad. So we'll go back to the jobs data. We'll talk about what happened in a minute. But the main thing to note here is instead of seeing weak jobs data, this was considered to be very strong jobs data. Actually, we'll talk about it and then we'll go back to the other stuff. So, I spent some time to write this all, put this all out here for you, and then I didn't use it. So today we'll be talking about a kick in the gut from the jobs data. We're waving goodbye to those Fed rate cut hopes, and could Friday's CPI save us? That is the question. So, see, I should have led with this. Where was I with this? Anyway, quick recap. So let's talk about let's stick to the script here. Let me get rid of this. Let's go here. So quick recap what happened yesterday. Taking a look here. Let me bring this up. Bring this up a little bit. All right. So take a look yesterday. Mortgage bonds where pricing came out right about here. We ended the day about the same. Very, very late in the afternoon, the last half an hour, we lost about 5 basis points. So that's partly reflected in there. It's partly why you see a difference on here, right? But not much of a real difference there. So everything was about the same on the day. No real difference. Now, we are obviously much lower here than we were here, which means, wow, pricing should be terrible. But if we add 10 basis points back into this, yesterday we ended the day at 100.08. Now we're at 99.92. We had minus 10 bips for the bond rollover. I didn't do that right. There you go. We had minus 10 bips for the bond rollover. So the reality is pricing's going to be worse today, but you're not going to see rates jump. You shouldn't see rates. They're not going to jump a quarter or even an eighth. You'll see slightly worse pricing today. So for somebody like Leslie, who said I had a borrower float into today, especially depending on when they're closing, it's not a big deal. So this is one of the first jobs datas that I had talked about floating into because of this. When you look at the fact that we're 5 basis points lower than yesterday, 6 basis points lower than yesterday, you look at where rate sheets were to end the day yesterday. We had some really good rates yesterday, and you're not going to be that much worse today. We went from 6.16 on Mortgage News Daily to 6.11. Today, worst case scenario, you'd go back to 6.16. But even that, we were up on the day yesterday. Where did we end the day? Up about 11 basis points. So for all intents and purposes, net bond rollover, you've given back 5-6 basis points of that, but you're still up. So The reality is that you're not going to see quite the same pricing that you would have seen yesterday, but it's really not going to be that much worse. So don't worry, Leslie. The sky is not falling. Now, what Ron Siegel pointed out on the Facebook post, I think he put it on the Facebook post. Here it was. Let's see if I can make this bigger. Like those skiers. All right. You know what I'm talking about? Who knows what I'm talking about with the skiers? Raise your hand. Give me a thumbs up. Anyone know what I'm talking about with the skiers and making it bigger? Let me know. It's kind of funny. So, but what Ron was showing is look at the we were up 18 basis points at 100.15 on the day, and the 10-year was at 4.11. And that's why we were floating into this report. There was a huge difference. And yes, I will break that down for Leroy and go over why this happened. The injections. I don't think it was saline. I think it was some other gel. Anyway, crazy stuff, man. So 10-year treasury yield was at 4.11. Take a look at where that is now. We're at 4.18. So the 10-year treasury yield did jump. There was a huge dump in mortgage bonds. They did lose from 830. We were at around 100.15. Now we're at 99.95. You're talking a 20 basis point drop here. We're minus 20 bips, right? So, that is a big deal. We gave up early gains is what happened. Bonds were really prepping. They were prepping for a move to see things happen. So quick recap, bonds were flat through the day yesterday after the early gains. We saw that. We've talked about that here. And markets were setting up for a weak labor report. When we looked here at the Fed data, remember yesterday, look at this. Look at the jump here. Yesterday, it was an 80% expectation that rates would remain the same at the March meeting. There's a 20% probability of a rate cut. That 20% probability here that we see, this 20% probability has now dropped to about a 5% probability. So markets are letting go of the idea that the Fed would need to cut rates in March. Now, I'm going to circle back and talk about the CPI data and if that could save this. But stay with me, right? So looking here on April, if you remember yesterday, there was a 36% expectation along with another 5. So it's basically about a 40%. The probability of rates remaining the same was less than 60%. Less than 60% for the April meeting. And remember, this is how likely would the Fed be to cut rates ahead of Powell leaving. Now, that has dropped all the way up to now it's about an 80% expectation that rates will remain the same as Powell is heading out the door in April. Markets have basically given up hope on that. Now, rate sheets today, again, I'm going to repeat myself for those that are joining late. Not as bad as it could have been. I know it feels bad. This morning, bonds were already up close to 20 basis points. So they were up about 15 basis points. We were in a position to see this continue to move lower. When the data came out, then it pushed things higher. And that's why. So, but compared to yesterday, we're only down about 5 basis points. And again, MBS Highway is not wrong. This is not wrong. It just doesn't reflect the bond rollover, which doesn't actually calculate into pricing. I know it's confusing, but it doesn't. Just trust me, we'll go with that one. So right now, I mean, using Mortgage MBS Live as the data center, we're down about 2 basis points from yesterday, even though you see this big dip, and that's because of the 10 basis point rollover. So this is, rate sheets should not be drastically different than yesterday. Should be slightly different, a little bit worse, but not drastically different. And using Mortgage News Daily, again, as a reference point, instead of 6.11, you'll be at 6.13, but you shouldn't be back to the previous, to Monday's 6.16. Right? You shouldn't be all the way back to Monday's rate sheet. Monday was here. Tuesday was really, really better. Wednesday, today, a little bit worse, but still not as bad as we were on Monday. That's what you should be seeing on rate sheets. Reprice risk on the day is low. Once we had this initial reaction to the jobs data that you see here, see this big drop? That is a legit clean drop. Look at the drop. Look at the sell off. However, since then, we've had a decent recovery and we're not seeing a lot of volatility. So we shouldn't have to worry about reprice risk through the day. In fact, bonds could continue to improve, and actually the 5.0 coupon could turn into positive territory through the day. So keep that in mind. The big difference is that Fed outlook, like I showed you, momentum was building that there was going to be a rate cut, and that is now pulled back again. So let's answer Leroy's question, and then I'm going to talk about the CPI data on Friday and if we want to lock or float. Okay, so looking at the jobs data, putting that up here as where we're at. We'll keep this up. Let's go ahead and look at Leroy's question. So he said, can you break it down like a 5-year-old? Which if jobs came out stronger than expected, which should be a sign of inflation decreasing, wouldn't they balance each other out? No. So first of all, inflation is taking a backseat to labor market. And this kind of ties into talking about that CPI report that's coming out on Friday. If inflation shows signs of cooling on Friday, it's not going to be enough to drive up the idea that the Fed will cut rates, because the Fed doesn't need to cut rates if inflation is cooling, whereas the Fed does need to cut rates if the labor market is hurting and needs help. If we have a weak labor market, then that requires the Fed to step in and try to spur the economy to get it to ramp up, to get more business coming in, to create more jobs because of more profits and more business and everything else. They need to heat up the economy. However, if inflation is falling, well, it's still above what the Fed wants it to be, and there's not enough benefit where the Fed would cut. If inflation is falling, then that is more of an indicator that the Fed is at a neutral rate where it should be. Whereas if we see weak labor data, that's a sign that the Fed needs to lower rates and help the economy and take a more aggressive approach. Does that make sense? Now, as far as the data itself, markets were expecting, we have seen so many indicators of weak labor. This really sticks out. And Ron, awesome, Leroy. I'm glad that worked. Leroy said perfect. And Mike Morano, he hit it. He said some of us need some of that old BS-BLS data, and that's the question, right? So at the last Fed meeting, Fed Chair Jerome Powell said the market's stabilizing. The labor market is stabilizing. That's what they said in their Fed comments, that the market was stabilizing. This points to a stable labor market. There's nothing that needs to be cut if this is happening. Now, all the other stuff, the ADP data, the jobless claims, the JOLTS data last week, all of the labor market data that we've gotten up till now over the last week or so has shown labor market weakness. So there's an argument. How accurate is this, right? How accurate is this? Well, the U.S. added 130,000 jobs in January, which beat estimates. The estimates were for 100 or I'm looking to see what it shows the estimates. Let's see if they showed in the Wall Street Journal one. All right. Estimates were expecting 55,000, according to Wall Street Journal, right? So that was the difference there. So they added 130. They were looking at 55,000. Unemployment rate went to 4.3 from 4.4. This is a big deal. And what makes that a double whammy is unemployment dropped, but what's called the participation rate went up. Participation rate went up. The participation rate is the number of people that say they're looking for a job. So that went from, let's see if they have participation here. Control F, Participation. Huh. I don't know why I'm not seeing that. So anyway, the participation rate did go up a little bit, not much, but it went up. And we have lower unemployment. So that shows labor market strength. Now, there's an argument about how accurate this is, but the estimates, of how many difference there were. Labor Department on Wednesday also sharply cut prior job numbers stretching back nearly 2 years. The U.S. produced only 1.2 million jobs in 2024 versus the previously estimated 2 million. The labor market slowed even more to add 181,000 jobs last year versus the previous estimate of 584. This is where you just have to wonder if all this stuff is made up. I mean, it's really hard to think that they're going to come up with this much of a change. But anyway, looking at this and what it's done for us, it was a big, big difference. And traders push Fed rate cut expectations now back to July. That's what we were looking at here. In fact, if you look at June, look at the expectation here. Yesterday, it was a 25% expectation that rates would remain the same. That's jumped up to 40% now. And July is when we start to see the idea of a rate cut now. Long after Powell leaves office and Warsh would take over if Warsh is approved, and confirmed by the Senate. So that's what we're looking at with all this stuff. What does it do again for rate sheets? If this continues and if this is, Ron said labor participation rate increases, good. Unemployment rate down, good. Yeah, exactly. Both of those are good things. Remember, labor data was not great. It just beat expectations. We need 100,000 jobs creation for status quo. We only beat that by 30,000. Estimate for jobs, 70,000 per MBS Live. Participation rate, 62.4 to 62.5. Thank you. See, it's funny. He's showing 70,000. When I looked at the Wall Street Journal, they were estimating 55,000. Mike said, I thought it was 150,000. No, it was never that high. That would be a miss then. It was never that high. Amber, you definitely nailed it. It's just like that game. Whose line is it anyway? It's all made up and the points don't matter. That's what it feels like with a lot of these reports. So, but all of this, keep an eye. What is a very, very, this is a good thing to see. The 10-year is still below 4.20. That's a big deal. We were above 4.20 for quite a while here, and we just recently again fell below 4.20. It was at 4.11 before it skyrocketed, this giant red line. Remember, yield going up is bad for the 10-year. We were that was a huge skyrocket, and it broke above, look at the high, it was 4.21, but it's back and it's still below 4.20. This is a good sign. Right now, according to MBS Live, we're flat on the day from yesterday. We have caught up. Again, the difference that you see in the chart here and why we're down, but we're still saying that we're even, is because of the minus 10 basis point bond rollover, because we're rolling over coupons. I'm not going to go into the full detail. Bottom line, it's not on your rate sheet. Rate sheets should not be that different today. That's the good news. Would love to hear when you guys start pricing loans, if that's what you find. And then let's get into that CPI data one more time. I alluded to it before, but I'm going to allude to it again. If the inflation data comes down, it's going to help bonds improve a little bit, but we're capped on how much improvement we can see. Inflation is the enemy of bond pricing, because if you're getting a return of $1 a month and that dollar buys a cup of coffee, right? We get a cup of coffee with that dollar. Well, in a year from now, I can't get a full cup of coffee. I can only get a cup of coffee every 2 days because it's the inflation and it costs more for that coffee. That's why the return on yield for bonds doesn't like inflation, because the money that you're being given doesn't change, but what that money buys does. That's why inflation is bad for bonds and bond yields and mortgage-backed securities and treasury yield and everything else. However, the fact that the inflation is improving a little bit, it's still above where the Fed wants it to be, and it's still inflation. So bonds are going to improve on that a little bit, but we're capped on how much improvement we can see from that. So keep that in mind going into Friday's CPI inflation data. And if that inflation data somehow were to double whammy us and come in higher than expected, that would kick us bad, because then there's no chance of a Fed rate cut because the Fed isn't going to cut rates if inflation is increasing and there's no reason to cut in order to heat up the labor market, right? To support the labor market. Right now, according to this data that we're looking at here, the Fed has no reason to cut rates to help the labor market. The labor market is stable, it's improving according to this data. It's only one piece of data, but it's a big piece. If inflation were to come in a little bit better, Fed still doesn't need to cut. If inflation were to come in worse, then there's no way that the Fed cuts. So we're really not likely. Do you see how Friday's CPI data is not really likely to be that helpful? That's kind of what we're looking at right now. So anyway, seeing what else do you guys have to say? Dave Zlinky said, I thought only 5 new jobs were added. Yeah, I don't know where you got that, dude. There were 130,000 jobs added. There you go. And next question will be, what does the next jobs report show since it comes up before the next Fed meeting? Yes, and that's what we talked about too, is that's part of the reason why there's not such a huge negative reaction to this jobs data, even though this is a negative reaction. It's not a huge one. And that is because we're going to, first week of March, we're going to get all of this data over again. And the next Fed meeting is March 18th. You see that here. It's March 18th. And that's why you're not seeing a big, a big, scary negative reaction, because there's going to be more jobs data. So, all right, my friends. Well, 26 minutes in, I still see 44 of you on. So hopefully you guys found some value to this. Please let me know in the comments. Did I talk too much today? Was it hard to understand? Did it make sense? Is it helpful? And I'm curious on how that compares to what others are going to share with you about information. A lot of people made it sound like the sky is falling on this, and unfortunately, it's more of a missed opportunity than as terrible as it could have been, right? If this data had come in weak, it was off to the races. Markets were really looking for a reason to rally on bonds and rally on the idea of a Fed rate cut. And we just didn't get it. This just didn't give us that opportunity. That's really what it comes down to. So hopefully this helps. Please let me know in the comments. And I do see you guys saying it. Dave Slinky, maybe anti-Trump article? Maybe. Good to see all of you, though. You got to work on my coffee analogy. Yeah, well, I got to drink more coffee. So cheers, my friends. I'll see you guys tomorrow. And thank you, Holly Johnson. Appreciate you. Y'all have a fantastic day, and we'll talk more tomorrow. Bye, everybody.